Welcome back to All Things Money. I'm David Blain, and during today's show, previous segments, we talked about unemployment and the jobs that are created in America, that all the net jobs created in America since 1977 have been at startups, and how we should be encouraging a tax and investment policy that encourages investment in startups and not bailouts of companies that are not traditional job creators. If you missed those segments, they're archived on the web at www.dlblain.com. There you'll find archives of all our shows, as well as information on myself and my firm. We also encourage you, our email for the show is allthingsmoney@dlblain.com. Send us an email, tell us what you think. Do you like the topics we cover? Would you like us to cover something else? If you have a question that you'd like addressed on the air, we'd be happy to do that if we have time. So also, if you want, you can give us a call at 252-633-0107. And that email again is allthingsmoney@dlblain.com. In fact, during this segment, we had a viewer. Actually, I think this was a listener from the radio that sent in a question, and it was related to the crisis of the banks. And as you recall, back in the fall of 2008, there was great concern that all the banks were failing, and there was all sorts of problems at the bank. And this woman asked the question if it was safe to put her money back in the bank. And so we're going to address that question here during this segment. The first thing I would comment is a little joke that I have, but it's kind of serious about it, is the worst place for your money is a bank. And so keep that in mind, that when you're looking to do something with your money, the last place you should think about is your bank. There are much more productive places to put your money. There are places that provide the safety and liquidity of banks without being subject to excess fees as well as lower interest rates. Just think about it. The banks are in business to make money. They make money by taking in deposits from people and loaning it out at a higher rate. And so just keep that in mind. The other thing about a bank that people don't realize is when you go down to the bank and you put your $1,000 in the bank, they loan that money out, that they don't have that money. They're allowed by law to lend out a certain percentage of whatever you put in the bank. And so a lot of people think that their money is actually kept in the bank. The reality is if a bank has, say, $1 billion in deposits, the dollar amount that they print on statements and send out to everybody, the reality is that actual cold hard money that they have available at any time, is probably only, $100 million, maybe at 10% of what they have. So just keep that in mind. So what we want to do is talk a little bit about the health of the banking industry. The banking system continues to recover. There's a big disparity between large and small banks. And it's my opinion that banks need more time to heal before the Fed even considers raising interest rates. So those are the three main topics. The system's recovering. Large banks more than small banks, but they're not out of the woods. And the Fed, in my opinion, should not even think about raising rates until there's some more stability in the banking system. So first of all, in quarter two, the bank's earnings improved, increased about 21.3%, the most since the third quarter of 2007. Most people focus on 2008, but the peak in the stock market and the peak in earnings was actually back in 2007 for most industries. Almost 2/3 of all banking institutions reported higher income compared to a year ago, but 1 in 5 still reported net losses. So 20% of the banks out there are still reporting net losses. Reduced loan loss provisions boosted bank earnings. Basically what that means is the banks set aside a certain percentage of their money as a reserve against loan losses. And as they no longer feel they need as much loan losses, they can reduce those, and it helps their earnings. And so asset quality continues to moderate. Non-current loans, which are 90 days or more past due, dropped but to 4.8% from the prior quarter. So the number of problem loans at banks dropped almost 5%. The coverage ratio, which is non-current loans to reserves, improved only fractionally to 65%. So what that means is that the banks have about 65% of the money in reserve for the loan loss. So if there's, say, $1 million loan that they think may go bad, well, they reserve some of that, and currently that ratio on $1 million loan, they'd have about $650,000 in reserve for that loan. So that ratio is not a tremendous, it's not covering 100%, but it's adequate, the banks feel, to cover their losses. So the earnings are improving. The bad loans are also improving. So the second point that I mentioned, the conditions at the too big to fail institutions or the larger banks continue to improve, but deteriorated at what we call the too small to save community banks. So you have the too big to fail and the too small to save. For example, the reduction in loan loss provisions was more prevalent among the larger banks. And at the smaller banks, we're seeing that their loan loss provisions are actually increasing. If we look at the number of problem banks rose to 829, that means that there are 829 banks that the FDIC feels are a problem. Of these, the majority are smaller banks. On their last list, they had 81 banks were undercapitalized, 61 were significantly undercapitalized, and 47 were critically undercapitalized. Basically what that means that 100 banks are really slated for imminent closure, and another 81 are at risk of falling to that point in the near future. And the majority of these banks obviously are your small community banks. So all in all, we think that things are continuing to recover. We're not advocating that you run down and take your money out of that small bank. There's still the FDIC insurance. But in terms of investing and the economy as a whole, we still see a lot of problems at the smaller banks. And any raise in rates at this point, we think would be detrimental to the whole banking industry. Well, that's all the time we have for today's show. I hope you enjoyed it. For All Things Money, I'm David Blain, and we hope that you join us again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.